Really, really interesting. I want to thank you all for, thank him for that wisdom. But what I heard was that we're heading to some sort of a recession. Uh, we have a credit crunch that's now, and there's great uncertainty about interest rates, unemployment. I also heard the word biblical. Okay, I never like to hear. But I did hear that we want to own tangible assets, which is real estate. So let's all think about that. So my name is Rob Geils, and I run a residential real estate team at the Corcoran Group in Lower Manhattan. And 2022 is probably our best year ever. And now things are a little bit more calm. I say calm in that, interest rates are double. It's really hard to find a rental that makes any sense. It's really hard to find an apartment. The inventory is really low, but that's kind of Manhattan. And our panelists are covering most of the country, if not all over the world. And they're in very different businesses than residential real estate are. So what I want to do is have them each introduce themselves. And we'll start with the panelists that are here. And Peter, I'm going to have you go last. So Christopher,
sure.
Why don't you introduce yourself and tell us, what your role is and what you focus on.
Is this working? You guys hear me?
I think so. Just
yeah.
hold it.
Yeah.
Okay. You turn it on? Yes. Turn it on.
Yep. We're good. Hi. So my name is Chris Destefano. I am the Chief Investment Officer at Northlight Capital Partners. We are a Connecticut-based private credit fund focused exclusively on real estate-backed, stressed, distressed, opportunistic whole loans. So our business is primarily in two lines. We acquire existing whole loans, either in the form of single asset mortgages or portfolios of mortgages. And we also originate what I would broadly define as special situations real estate backed debt. And so that sort of covers a broad swath of categories, including bankruptcy financings, DIP loans, and exit facilities, as well as sort of what I would say are new loan originations for everything from out of favor asset classes to legally entangled situations, sort of everything that would involve some sort of stress or hair or, for lack of a better word, brain damage associated with those assets. We typically work in the middle market, so we are not the guys that are going up against your Blackstones or Lone Stars or those guys. Our typical deal size is somewhere between $10 and $100 million. And we allocate that across our fund as well as co-investment partners, of which we have several and are always sort of on the hunt for more. And that allows us to sort of stretch our deal size up to that $100 million level. We are currently in the market raising our fourth fund, and excited to give you guys my thoughts on the credit markets and real estate world. Thanks.
Thanks, Chris. My name's Kevin White. I'm the managing partner of Spring Hill Capital Partners. We are a family office backed investment company. We're very opportunistic. I will make the disclosure right now that we have actually 0 assets under management. We're pretty excited about that just because given the world right now, I think a lot of people are going to be in workout modes. We were very active post 2008 during the global financial crisis, buying anything from securities to, when I say securities, AAA securities, where we're the controlling class representative that were defaulted, to lower down in the well called CMBS, kind of alphabet soup down in the lower credit slices of CMBS, to loans. Some loans we ended up taking the asset. We ended up taking foreclosure of a couple multifamily deals in Biloxi, Mississippi. We wouldn't proactively buy it, but we ended up owning those and managed out of those. And we sold our last portfolio just coincidentally on March 6th of 2020, not knowing there was any sort of pandemic on the horizon. It was just the rhythm of the business. And we gave all of our money back to our investors. We don't raise funds. We do it a little bit different. We have a handful of large billionaire families, and I realized early on, I was at Lehman Brothers, and when we went bankrupt and I started on my own, that the probability that I could raise $1 institutionally is 0 with no track record, the Lehman Brothers taint and lost a lot of money at Lehman Brothers during the bankruptcy. So the probability that someone would give you an institutional allocation is zero. We did, however, during the time at Lehman, spent a lot of time with families, large, very large global billionaire families. And that became our capital. You earn trust with them. You became transparent, became an advisor to them, and that's kind of how we operate. And I realized early on that the families collectively have $32 billion in cash, and we could never raise $32 billion in cash. So we just decided that we're better off finding good deals, sourcing good deals, underwriting them, diligencing them, and then working out the business plan. And that's kind of who we are right now.
Thank you. So Peter, you're online. Can you tell us what you do and a little bit about what your focus is specifically around real estate? I know you do a few other things.
Yes, good morning, everybody. And thanks again, Marty, for having me on your panel again today. Peter Plaut, Plaut Advisory. I've got 30 years of sell side and buy side experience, both in the US and Europe. I'm both a British citizen and a US citizen, so I spend my time equally between two areas. Currently, I'm in Miami, but I spend a lot of time in New York, London, and Miami. My focus is on origination and research of deal flow investments, mostly private credit focused for family offices and selected institutional investors. I also focus on raising capital, given my deep bench of family offices, credit funds, asset managers, sovereign wealth funds, etc. My primary focus is real estate. The last 7 to 10 years, I've been focused on origination, due diligence, and placing capital for a large multifamily office out of London and Denmark, where we invested across the real estate spectrum from residential to office to a lot of hospitality, and that was global with a minimum size of 150 million to $1 billion. So I've been focused predominantly there. Given the outlook for the next 12 to 18 months, and now that I'm back in the States firmly with my own shingle, I'm really focused on both an advisor to family offices and others in terms of manager selection. We discussed that, but not necessarily on the granularity, but more on sourcing and origination of private credit deal flow. And in many cases, that's stuff that's uncorrelated to the markets, equity and debt. So obviously a longer gestation period. So for this panel, I'll be focused on the outlook for residential real estate and how I'm looking at that, for my family office clients.
Excellent. Thank you so much. So what I wanted to move on to was the banking turmoil, and how has the banking turmoil and tight credit affected your specific business? Has it created opportunities for you? We'll start with.
Sure. The short answer is yes. And I think the longer answer is it's an ongoing process. The credit market in sort of the middle market, private CRE lending market had already dried up dramatically. I would say over the last 18 months to 24 months. We were pricing deals. You have to remember too, we're typically distressed guys. So most of the time, at least historically, when I would quote a deal, I would roundly be told to get lost. And so I got used to being told to hit the road. And we were pricing deals on asset classes that we thought we'd never trade on. So multifamily in particular is an asset class where we never saw anything for, we've been in business in 2008. I didn't see a multifamily deal that would look at me until a year and a half ago. And now we were getting multifamily deals done. So what has happened recently, we sort of look at the world as a leading and a lagging space. The leading space is more of sort of that immediate dry up of liquidity in CRE lending. And I think that happens pretty quickly. And so we are getting repeat calls on a consistent basis from development projects, refinancings, recapitalizations, where traditional lenders have just essentially evaporated. The lagging piece is sort of what I would say is the loan sale market. And we are starting to see drippings through that market of defaulted and stressed CRE loans coming to market. I think that is going to be a developing market over the next 12 to 18 months were those flows, which have increased already, but will increase more dramatically. The interesting thing I think about that business is that it's not necessarily a contagion of bad assets. I think it's more of a contagion of it's more of a capital markets problem. So I think leverage and the lack of refinance capital is going to be the driving source behind some of those issues, not so much the operational issues that you might traditionally see. And so I think that actually makes for a pretty interesting buyer's market, and that you can get your hands on some pretty interesting, decent collateral with good borrowers at some pretty decent prices, because of the liquidity dry up on the credit side has just been so dramatic.
Thanks. I couldn't agree more. I mean, I think that the fundamental problem is that no one that we know has ever lived in a market like this, right? Because everyone that we know, for the most part, has started in like 82 or so. I started in business in 1986. And then, so rates went directionally down from 82 to 2022. And so everyone's smart, right? So everyone's smart because rates go down, so asset prices go up. So everyone look around, you're all brilliant, you're all smart. Now, anyone that's long assets, when the rates go, with the Fed being aggressive, go from 0 to 5 in such a short order, anyone who's long assets, they're not immune to it. It's just math, right? So we were on the sidelines. I've been walking my dogs for the last couple of years in the woods, and just kind of reading things and talking to people and trying to stay out of my wife's hair. And then I read this article about BREIT and the things that are happening at BREIT, Blackstone's REIT, and the money that they got from Cal Regents, the $4.5 billion. And look, Blackstone's, they're wonderful. They're smart. They're global. And if anyone can pull off a difficult landing, it's John Gray. There's no debate about it. But when you take a look at what's going on, the underlying premise is that if you just do the math, right, their average cap rate's 5.5% in BREIT, and rates are out 150 to 200 basis points, right? So 20 over 5 is 40%. So 1.5 over 5.5 is roughly 30%. That's just destruction of value. And so if you have a levered asset class, then there is no equity, right? And so that's the way we're looking at things right now, is that there's no equity in the world right now. That doesn't mean they're going to lose the building, but there's no equity. So you don't pay for equity, you buy the debt. And we're buying or looking at debt right now. We haven't bought anything yet. We are looking very closely at the Signature portfolio, and that's going to be very interesting. It's going to be very telling to see what's in there, the process, what's happening, how they're going to dispose of it, what kind of financing you're going to get. And this is going to be, I think it's going to be an interesting and shed a lot of light as to what other banks have in their portfolios too. Because this is the first thing that's going to have some transparency, and they're right in the middle of that. And so, it's going to be interesting. I don't think you have to rush to do anything right now, but I do think that if you can buy first mortgage debt at a discount, by definition, there's nothing above you. There's no equity, there's no mezz, all that stuff's wiped out. And that's kind of how we look at it.
Excellent. Thank you. Peter, would you like to comment, please?
Yeah, so I've been focused on banks and non-performing loans for since the late 80s, from the Resolution Trust Corp and a number of crises all over the world. And clearly, the unprecedented sharp rise in rates is a interesting catalyst. I think what the biggest concern for me right now, and the family offices that I deal with, is basically what is the market clearing level. A lot of funds have, Blackstone just raised a $30 billion fund for real estate. But until we see for each asset class a particular transaction, a large transaction that takes place, we really don't have a bottom, and therefore we can't price stuff as efficiently right now. So it's really that market clearing level that I think is we need to wait and see over the next 12 to 18 months. Otherwise, we're just going to see a lot of dry powder just sitting on the sidelines. But the opportunities in distress, I don't think we're seeing a global financial crisis type of large buckets of OREO and large amounts of non-performing loans that banks have to get off their books. So I think that sale process will take a lot more time. But what I am seeing is a lot of funds, given that you need more equity into a transaction than in the past. That basically means the IRRs on your opportunities are much lower. And if the IRRs are a lot lower, that basically limits the investor base for this. So what I'm seeing is a lot of companies might just say rates are too high. We had a floating rate exposure, and we give back the keys to the respective bank. The bank doesn't have to sell it at a massive distress level. So, they might take their time in terms of selling, and they have the capital to do so. So I think it's going to be more of an IV drip in terms of this distress cycle where it takes time. And on top of that, given a lot of large investors sitting on the sidelines with dry capital, that also prevents us from seeing across different asset classes what that bottom is and what that market clearing level is.
Can I make a comment? You go.
Yeah, go ahead, please.
Yeah, that's a good point. So one thing to add on that, I think the fundamental difference between today and yesterday is, when rates are going down, right, the lenders will work on you because you have a lower rate. You can kind of work things out. They'll extend it. So today, and for years, for 20 years, people did cash out refi. You've heard about that expression, cash out refi, cash out refi. Well, today it's cash in refi. And that's the difference, right? People just don't have the equity, and some people aren't going to want to protect their deal because they think the asset value is going lower. So why put new money into bad? So the cash in refi is going to be critically important, I think, in this stage. And critically important as well is that we're in a higher rate environment, right? So the lenders aren't going to give you that tolerance to work things out. And the third thing is this little clause in Dodd-Frank that the banks are being held accountable to is called CECL. And I think CECL is something that stands for current expected credit losses. So the current expected credit losses, the regulators are going to be in saying, if you have your asset marked at par and the market's telling you it's worth 80, well, in the last cycle, the banks would work that out and extend that because they hadn't had the reserves against that. Today, the regulators are saying, okay, that asset is, the market value is 80. You have it marked at par, start working out. So they start creating a reserve. So when we come in and say, we'll give you 80 cents on the dollar for your debt, then they have the reserve offset against it. I think that's going to be a critically important piece today in the puzzle as the regulators create these crumple zones around Dodd-Frank and around the banks that will keep things moving, in my opinion.
I agree with that as well. I wanted to make a point that Peter made as it relates to sort of this lag in between and finding a clearing price and finding where stuff is actually going to trade. And I can say from experience, we've been on multiple things, both single assets and portfolios over the last 3 to 4 months that just haven't traded at all. And so I think there still has yet to be this sort of come to Jesus moment between some of the acquirers like myself and the sellers, be they banks or alternative lending platforms, in terms of exactly what that value is. And so I think Peter's point is definitely a valid one, and I think it's going to take some time to find that level, and that's when that drip will start to happen. So
Great, thank you. So let's talk a little bit about something more macro, long-term changes in what work looks like and how it's affecting different categories like office. I think office has been a very hot topic in what you're just talking about. So where do you think the best opportunities are? Do you all get involved with resi, warehouse, industrial, hotel? What are your favorites?
Well, we are contrarian investors. So when everyone says they don't like office and won't lend to office, that kind of, we get an eyebrow raised when we look at office. And office is very difficult to kind of calibrate. It's very risky because no one knows exactly how it's going to settle out, right? So pre kind of COVID, we had a kind of a steady state of A, B, and C, kind of uppercase A, B, and C office spaces. We all know them, so trophy office, B, and C. And today, I think we have, it's taken that oil and water emulsion and mix it up, and no one really knows how it's going to settle out yet. No one knows what assets are going to be truly A and reemerge A. But I think that when the millennials, get the reality check that you can't live from home forever and be productive, and people start getting fired, and they are going to come back to the office, right? Because I think that there's going to be a high correlation with those who are working from home that are on the RIF lists. And that's just going to happen. Every CEO I talk to, they just say, they're not my people. If they're staying home, it's easy to fire someone you don't know. But as opposed to someone who comes in every day and is working with me in the trenches, that person I'm going to protect. And I think that's going to start to roll out. So you will have office demand. I don't think that all these buildings that we look around here are going to be worthless. There are some that will be worthless and should be knocked down. But I think it's going to be lowercase a, B, and C. For us, as we look at lowercase a, b, and c, well, we're probably not going to play in that institutional A quality space because institutional money is going to come in there and it's going to price us out of the market. We will look at the A- and the B+ stuff in office. And I think there's going to be some generational opportunities to acquire office in areas like San Francisco. People don't want to go there, but we'll go there. New York, other places that people want to run away from. We'll look at them because I think that's going to just be a repricing. And the C quality stuff that people think you can repurpose. Oh, good luck to you. I mean, we think that's a really long putt, and we don't think that you can do that effectively, but we don't have the skills for that. And so if someone can do that, then I wish them all the luck in the world. But I think there's going to be some generational opportunities for office.
So actually, can I ask you a question on the office? Because I don't understand it at all. So is the theory that the C will essentially evaporate? A will start to price a little bit more like B. B will price like C, and then C will just cease to exist.
I think it's just be smaller. So if you look at the office stock today, right? You look at some of the big REITs and what the public market's telling you versus the private market's telling you. It's very telling, right?
Finish your statement. I have a question about all.
Okay, so it's very telling. So if you look at Vornado, you look at SL Green, you look at Boston Property, the equity market is telling you that it's trading on option value, which means that there is no equity in the portfolio. They're trading on option value because they think these iconic real estate developers, personalities, whether it's Steve Roth or Mark Halliday, can go out and raise the capital because there is no equity in the portfolio right now. And the debt that's coming due, if you look at SL Green's kind of asset values, enterprise values like 11 billion, they have 9 billion of debt coming due. So where's that debt going to come from, and at what loan to value does it come from? So the CMBS market's closed. No one wants office. The existing international investors, the Koreans and the Singaporean and the sovereign wealth firms, they've all been burned. They're not going to just necessarily double down. I personally would bet that there's something really interesting at SL Green, right? The market cap's $1.5 billion. The one Vanderbilt alone cost $4 billion to build. So that's telling you that the rest of the portfolio is worthless, right? So I think it might have overshot, but it's going to be a fascinating kind of observation to watch, and I think that there will be some interesting opportunities.
So now I actually have two questions from your top statement. So my first question has to do with, isn't real estate geography kind of dependent, right? Because I mean, if you're like in the South, and like I think Orlando is a great place to be doing office. Some people have done office in Orlando, but if you're like in the South, like you're in South Florida, Texas, repurposing happens pretty fast. I mean, any real estate that's there will get repurposed. Is that? But I mean, maybe if you're in New England, it's a story of California. Your thoughts on that? I mean, the geography.
Well, I think that the net. You're right. Manhattan real estate is more important and is pricey than other places, and so is San Francisco. I totally agree with that. Just the cost to build and the replacement cost. I mean, no one's going to put up an office building next 20 years, right? So if you can buy something and fix it, then you probably get some good. If you have a good basis, I think that. Some of the regional markets that, tier 2 and tier 3, there are really compelling reasons to look at, and again, without creating a political, lightning rod, the blue states versus the red states. I mean, a lot of people are going to gravitate towards the red states because people are going to move there and live there, whether it's Nashville or Austin or Jacksonville or some of these other places that there's an attractive component to that versus what's going on in San Francisco and other areas that are blue, that are running things out, whether there's Boston or New York, whoever. There's
no doubt that there's a massive migration out of blue states into red states. I mean, that's happening.
Right. So the buildings aren't going to disappear. They're just going to be the utilization of the office space is going to be sized differently and priced differently.
Okay. And then my follow-up question was, I mean, SL Green seems to be a pretty big operator, a lot of big real estate operators out there. Are they going to get rescued at some point, or will it just be banks that get rescued? I mean, Morgan Stanley has a lot of CRE debt.
When you say are they going to get rescued, is the government going to rescue SL Green? No.
Yeah.
I mean, I would be really shocked.
Banks, but I don't see the Fed rescuing these large real estate players. But your thoughts?
Oh, I think there's a zero probability that the government comes in and rescues these rich developers. I mean, I think that would be zero probability. If they do, then we are in a whole different set of.
I just want
to. That's that kind of mind numbing. And some of these people you've seen RXR and some of these guys out there talking about the government needs to do this. So, well, I mean, maybe the government can provide some financing for someone to come in to buy the debt because the equity's wiped out.
Peter, look, I want to add something to the SL Green type discussion. So if you look back at 2009, it's a different crisis. Sorry. If you look at 2009, which was a different crisis, and we're not quite sure that we're really in the crisis yet here. We might be, a lot of people think that's where we're headed. But in 2009, companies like Vornado and Simon Property and SL Green traded even much lower than you see today. And you had a market environment where people thought nobody was ever going to be able to finance any deal ever, which is why they traded that way. The bonds went really wide and the preferreds went really wide. Here, SL Green certainly has gotten, not to pick on SL Green, but gotten whacked and down 75% on an equity basis. But I don't know that they need, quote unquote, a rescue, and time will tell. There's still a functional, going concern, just at a much, much lower valuation with debt problems. What happened the last time is all these companies raised equity. Even when it, as painful as it was, Simon raised equity at $20 a share. SL Green raised equity at $9 a share. So, and Marty, that's one of the ways that some of these companies may work their way out of this, to raise money to pay down some of their debts so they can extend their debt, is by raising equity, as dilutive as it will be for other shareholders. So that's just something to consider, particularly when you look at other well-capitalized funds sitting there looking, what are we going to do with our money? What's Blackstone going to do with $30 billion? I wouldn't be surprised to see them take stakes in some of these, both public companies and private companies.
Excellent. Peter, do you have any
Yeah,
comments?
I have a couple things I want to just talk about on the macro side. Going in terms of the Class C office space, let's look at something from a global basis. In the UK and Europe, we have something called mandated carbon neutrality by 2030. That's just 7 years away. Now, that could be backstopped another 5 or 10 years, but what that basically means is this retrofitting of buildings is just not going to happen, particularly on the Class C, even the Class B. There's too many office buildings sitting around the UK, Europe, and obviously in the US that all can't just be repositioned for BTR or hospitality and others. And so those that are classified as a Class C will not have any buy-in for them. They'll just be stranded assets with no home. And knocking down the buildings presents a larger carbon footprint than trying to retrofit them. So we're facing in the UK and Europe a significant amount of potential stranded assets with no clearing level, even on pennies on the dollar, that are going to be there. So I think that's something that you need to keep in mind. The second thing you need to keep in mind, I come from a research background, so I'm always looking at regulatory issues and how those regulatory issues tend to fuck up things for investment opportunities. And it happens time and time again. So just on that, obviously the migration is something that's key. The fact that there's not going to be any bailout for these rich developers. And when you look at look at the numbers in terms of the amount of equity now that needs to be put in, when you're looking at LTCs and LTVs and stuff, the numbers just don't make sense in the current environment, in a rising rate environment, in case many of these assets are financed on a floating rate basis. So that leads me to a large concern. That being said, though, taking a contrarian view, if I could find an office asset in a great location, whether that's in a kind of a red state or even a larger urban area, but I'm buying at a significant discount to replacement cost, and it's been retrofitted, let's say in the last 5 to 7 years, that might be something that presents a good opportunity. So trying to find, distressed assets that aren't that distressed, call them more stressed, at a favorable entry point so that my IRRs make sense, is something that needs to be taken into account.
You bring up a good point. So the Union Bank building in LA traded at, it's a mind-numbing number. It's $150, $157 a square foot. You can't build anything out there right now with, when you just build it, let alone, take the time and carry to get the permits and entitlements and everything else for less than $1,000 a square foot. So you're buying it at a pretty cheap basis. That said, these buildings, they consume a lot of capital, right? So you have to have the HVAC up, the improvements that were just referenced. property taxes, electrical taxes, everything else. It's not for necessarily the right person. Some of our families would love to look at those things because they can hold them for generations because they know that I don't care about it for 10 years. I'll hold it for 10 years. It can sit empty. A fund can't do that. A fund needs to get a return and get this thing out the door. Marty, you mentioned earlier about bailout. There's an interesting study that I was reading that Freddie Mac put out. You should go on their website. It's a fascinating read about the multifamily business and their 2023 outlook. And so I'm reading through this thing and I get to page 16 and then there's all these charts and all these different colored charts about the different owners and different lenders and constituents in multifamily. And then in the last 4 years, this little black bar went like this, like this, like this, like this. And it became the obvious, like it was the elephant in the room, like, and it said other, right? So just labeled other, not GSE, not bank, not insurance company. It was labeled other. So I shoot a note to the private credit, and that's what the Fed and the regulators are trying to do. Is they're trying to push the risk outside of the banking system, and it goes into the non-banking system. So I think that's when you look at whether it's Blackstone or Ares or Carlyle or some of these private real estate people. I think that's where a lot of the risk lies. I'd be really surprised if the government comes in and, no offense, comes in and bails you out.
They should
Right?
not.
I'd be really, really surprised if they do that.
Many people in our group don't want speculators to get bailed out.
I agree with that.
So how much time do we have?
About 10 more minutes.
Okay. So you mentioned a little bit about environmental issues and HVAC and regulation. I think all of you have, focused on different areas. Where are the opportunities, or what are the biggest challenges around environmental issues and ESG, and how it affects different categories? Any comments about that?
Well, from my perspective, I mean, we're not operators generally unless we go in and foreclose on a property, at which point we typically will bring in and partner with a local best-in-class operator. I mean, we certainly have ESG policies for ourselves as a fund. I mean, we have been involved on an ongoing basis in brownfield projects or remediation work, which I think is an interesting spot. It's always sort of tricky and dicey from a debt perspective, because there are obviously issues with chain of title and ongoing indemnity associated with or liability associated with the environmental. But from an asset class perspective, I don't know that I can really shed a ton of light on what we're seeing from an ESG perspective.
Okay.
You guys talk about office level. What about people who are buying multifamily? Like the people who are like, I guess a lot of the large multifamily asset managers have gone on these spending sprees the last 4 or 5 years, just buying up everything in sight, communities, et cetera. Thoughts on that?
Well, yeah. So we've seen, as I said, I think I mentioned before, multifamily suddenly became an asset class that we could look at 6 months ago, a year ago, and I think that stems from the fact that we three caps don't compute in my world. I can't get my brain around it. I have no interest. There's no value that would make sense for me to loan at a 3 cap. And so I do think you're seeing sort of a little bit of a repricing there. But I also think a lot of it has to do with the fact that the credit markets have changed so dramatically in a very short term. So you're seeing forced repricings to get financings done. At least that's what we're seeing.
I mean, people really went on huge buying for years, last 5 years, right?
Yeah.
So interestingly, that's the thesis that we, when we've invested post 08, we invested because, we did an analysis that home ownership went from historically 62% to almost 70%. And that every 1 percentage point was like 1 million homes. And so when the subprime thing hit and everyone got displaced, they had to go somewhere. So we started buying the debt on multifamily around the country. We competed against Lone Star and Colony and all these big, we were a little group, but we have lots of money behind us. So that was what we did, and we just played it through the debt. Today, when you think about, you take a step back and you think about, demographics, the millennials, the trends, what's going on, we still like multifamily as an asset class. It's probably the only asset class that we really like because of, there are 15 million people who are mortgage ready today, but because of the spike in rates, can't afford a home. They have to go somewhere. The multifamily, to your point, has been financed for the last 20 years perfectly. When I say that, you buy it at a 5 cap, you finance with 4% debt. You buy it at a 4.5% cap, you finance with 3.5% debt. Down, 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 down. Now, these people that, like, there's a deal in Boston that just is going to trade in now. It's Avalon Bay, beautiful asset class, state of the art. A year ago, that would have traded at a 3.25 cap. Today, it's going to trade, it's going to clear it at 4.75, right? So that's 150 basis points, wider on a 3.25, right? So we can do the math. That's almost 50% destruction of value, right there. The financing on that asset class is 5.5%. So no one's going to put negative leverage on that deal, right? So some institutional buyer is going to sit on it and own it. But all the people out there that were buying asset classes and financing them perfectly in 18, 5 years later, that 3.5% debt is now 7, right? So you do the math on, you buy $100, you put up 30, you borrow 70, right? 5 years later, that 70 bucks of debt is still there. Your equities wipe out because your asset class was at 100, and now it's down almost 40%. So your assets worth 60, your debt's worth 70, right? And now you have to come out of pocket to refinance the debt, and your new LTV is not going to be 70%. It's going to be somewhere around 60. So it's the world's upside down, and there are a lot of individual people that are buying that along these, and I think that's going to be an interesting play to go kind of recap and buy those things.
Yeah, recapitalizations are going to be a big part of this rebound when and if it happens, or not when it happens, I guess, not if. Yeah, because they're upside down all over the place, Marty.
Do you think we're going to go through like a period of like bankruptcies like in 2008?
I do.
Peter, do you have any comments about this?
No, guys, I think it's all answered. So very good.
Okay. Okay, we have a question.
Yeah, I mean, first of all, I guess the people have locked it up for the next 3 or 4 years or 5 years, right? Or 10-year, GSE debt. So there's quite a number of people who are, extending their debt, and there is a huge, outlook change between now and 10 years from now, and we know the interest rates. That there's a very big demographics, whether we have a Japan cycle, recession, and all that. And if you end up in a shallow recession, and the Fed really ultimately have to change direction, maybe not as rapidly, and the short rates fall, and definitely the long rates will react. So do we think that this is a little bit of overstatement of that we really have a crisis here? Is more of a maneuvering through if these buyers or owners essentially are going to hang out. And we're not seeing any really price action going on in the multifamily today, representing that kind of a view from the panel. I'm just trying to contrast that with the speed in terms of what real family are looking at.
Yeah, my opinion is that the issue, it's a timing mismatch. I would agree with you, right? That if you have the time is always the most valuable thing. If you have the time, right, to wade through, 10 years from now is very different than a year from now. But if you're a local operator, right, and you've got a refinancing that's facing you in a year, and all the banks in the United States that were the primary drivers of lending into the CRE space are suddenly suffering from massive deposit withdrawals, right? And all that liquidity is gone. Now they're faced with a real challenge in a year and a half or 2 years. Who cares what it's going to look like in 10 years? In 2 years, they can't get the refinancing they need. And now the bank has to make a decision what they're going to do with that asset. Are they going to extend it? Are they going to foreclose? Are they going to classify it? Are they going to write it down? So to my point, I think it is a capital markets problem. I don't know that it's an operations problem. I think it's a capital markets problem, but it's a mismatch of timing, right? A lot of these guys can't wait the 10 years.
Getting back into timing, so I got contacted by a developer maybe 5 years ago out in Texas who had built out one of the towns that's where the Dallas Cowboys practice stadium is. And he was from Georgia. And so he says, I got to refinance $500 million that's coming to help me out. First thing I did is I called up all my Georgia contacts, because they have extensive Georgia contacts. And they said, oh, yeah, we know this guy. Half his projects have failed in Georgia we defaulted, so we're just gonna wait it out. Do you think that situation is gonna happen a lot down the road?
Yeah, I do. We had actually a deal that we're looking at, and Ron, it gets to your question that there are institutional sponsors and then there are non-institutional sponsors. And I think the multifamily asset class throughout the country over the last 10 years, there's been a lot of mom and pop people that had made a few bucks and decided that I want to kind of create an asset for my retirement and a generational asset. So there's a lot of people out there that aren't deeply sophisticated. It's three guys. We put together a syndicate. We borrow 50 million bucks and then we go build something. And if they get it done, great. But a lot of these people now that refinance that, they don't have another 25 million bucks to throw into the deal. So there's going to be that recap deal. The other thing is that the banks are sitting there going, okay, well, am I supposed to take an REO asset back? They don't want that. They're not in the business to be selling assets. We saw that in the S&L crisis. So a real deal that came across that we looked at, and this is kind of our investment thesis today, is that there was an $850 million multifamily, very large deal, right? The structure, the cap stack was $850 of asset, $150 million of equity from Blackstone, $100 million of mezzanine financing, and a $600 million mortgage. Okay, the mortgage traded at 90 cents on the dollar, right? The coupon was 6%. It's a 5-year mortgage. So that's another 10. That's 10 points over 10 points over 5. It's 2 points a year. So you get an 8% current yield. We would take that all day long with an option to buy that asset. So it's a debt play. It's a really kind of an option strategy where we'll buy the debt. If Blackstone pays us back, which they probably will, then we make our 8% return. And all these families would like that 8% return. If Blackstone doesn't pay us back, or this other non-Blackstone institutional person doesn't pay us back, then our basis now we're coming in at 54 cents on the dollar.
I think the overarching theme, which I think Kevin would, I don't want to put words in your mouth, but that I would say is the way we look at the world is like, look, if you can own first lien real estate debt at a discount in this world, that you're the equity guy. You're owning you're the owner, right? So that's how we look at the world, is like spreads have widened on high yield, and we're quoting SOFR plus 1,000 on some of our deals. And if I can do that with a piece of the back end on a first lien debt, like to your point, I would do that all day long.
Great risk adjusted returns.
Yeah.
Do you guys have any indication of the special servicers for CMBS?
Last question.
This will be our last question.
Whether they're going to extend and pretend, or they're going to take ownership?
I think they have to take ownership. Right? They can't extend and pretend in a higher rate environment. Someone's got to come out of it. Again, it's not cash out refi, it's cash in refi. So there's going to be a workout, and they're going to have to sell it. They don't have the equity capital to take all these things down. And so there'll be an auction. There'll be a spigot where we'll see loans go through CMBS into the special servicer and then out to the public market. There'll be a process for that. And they have to run a process based on, because they have to be responsible to all the other debt holders. This is going to work out, and there's a process, and they're going to do that as a special servicer. Then there's going to be the banks, and the banks have a regulatory guy around CECL. So there are crumple zones around everything. No one's going to buy these off-market deals. Everyone tells you they have an off-market deal. Like, I've heard that 1,000 times. It's too efficient, but a lot's coming right now.
Excellent. All right, man.